Welcome to The Explainer. All right, today we're diving into the absolutely wild story behind one of crypto's most volatile assets, the River token. It's really a classic tale of massive hype, cool new technology, and some pretty extreme market forces all colliding at once. So get this, in early 2026, in just 30 days, River went on a mind-bending run, shooting up more than 1,600%. I mean, for anyone watching the markets, it was the kind of move you'd dream about. Just absolutely parabolic.
But you know how it goes, especially in crypto. What goes straight up can come straight down, and it can happen fast. The token then came crashing down, wiping out a staggering 86% of its value from that peak. Just gone.
Yeah, exactly. An explosion like that, immediately followed by a total collapse, it leaves everybody scratching their heads, asking the same thing. How does something like this even happen? And more importantly, why? Okay, let's get into it.
To really get the story of River, you first have to understand the battlefield where these things play out. And that battlefield? It's the chaotic world of social media, where traders and investors are all shouting their wildly different opinions at the same time. On one side, you've got the bulls. They're all about the rocket emojis, talking about life-changing gains, absolutely convinced the price is headed for the moon. And on the other side of the fence, you have the bears, looking at the exact same chart and seeing a disaster waiting to happen. And the bullish argument? A lot of the time it was just pure hype and emotion. We're talking about printing money, make-or-break moments, all designed to create this powerful sense of FOMO, that fear of missing out. And then you have the bearish case, which was the complete opposite. It was cold, totally detached, and all about the technicals. No emotion, no hype, just here's the entry, here's the stop loss, here's where we take profit. Just pure numbers. So with all that noise, what was actually lighting the fuse? What was the real story behind that massive initial surge? Well, it wasn't just random chance. A few very real things happened that poured gasoline on the fire. Let's break it down.
Okay, so it all went down in January 2026. The price starts to break out around the 11th, which is cool. But then, boom, Tron founder Justin Sun announces he's dropping a major investment. That's followed almost immediately by new exchange listings. And just a few days after that, the price just explodes to its all-time high of almost $88.
And this is where it gets really interesting, right? Because these things didn't just happen in a vacuum. They fed off each other, creating a perfect storm. The Justin Sun investment gave the project instant credibility. The new listings opened the floodgates for a ton of new traders. And then you had other big-name influencers jumping in, creating a hype cycle that just became impossible to ignore.
But just when you thought the story was all about hype and positive news, well, if you looked a little closer at the blockchain data itself, you'd see a much darker story hiding right underneath the surface. So the on-chain detectives, the people who actually analyzed the public ledger, they started digging, and they found something pretty alarming. It turns out one single entity, just one, using thousands of different wallets to hide their tracks, was controlling almost half of all the River tokens out there. That is a gigantic red flag for market manipulation.
And this chart just lays it all out, doesn't it? I mean, look at that. It was basically a game where one player held nearly half the cards. That single whale had the power to crash the entire market whenever they wanted, just by deciding to sell. And everyone else? They were just along for the ride. Okay, but there was another hidden risk, and it's a metric that a lot of people tend to overlook. It's called fully diluted valuation, or FDV for short. It's a really simple concept, but it's incredibly powerful. So check this out. You've got the market cap on the left. That's the value of all the tokens that are actually out there trading right now. But then on the right, you have the fully diluted valuation. That's the value if every single token, including all the ones locked up by insiders and early investors, was on the market. That massive 5-to-1 gap? That's the problem. It means a ton of people are sitting on huge paper profits, creating this constant underlying pressure to sell the second their tokens unlock. So you have this insane hype and this crazy valuation, but it's all shadowed by these huge hidden risks, which kind of begs the question, what's the actual tech here? What was River Protocol supposed to be doing to justify all this in the first place? Let's take a look. At its heart, River Protocol is trying to solve one of the biggest headaches in crypto, getting different blockchains to actually talk to each other. They call it chain abstraction, which is really just a fancy way of saying you can move your value around without having to use those complicated and often really risky bridges that you hear about getting hacked all the time. And the way it works is pretty clever.
For instance, you could lock up your assets on one chain, say Ethereum, and then use that as collateral to create the protocol's own stablecoin, satUSD, on a totally different chain like Tron. The whole idea is just to make everything safer and way more efficient than the old way of doing things. So, after that absolute roller coaster ride, what are the actual lessons we can take away? The whole story of River really just hammers home some timeless, classic trading principles that this whole thing illustrates perfectly.
I'm pretty sure you've all heard the phrase, buy the dip. The idea sounds simple, right? The price of an asset you believe in goes down, you see it as a sale, and you scoop some up at a discount. But here's the thing. Professionals don't just blindly throw all their money at every single price drop. They use a system, a strategy, like this ladder approach. Instead of going all in at once, you break up your investment into pieces, and you buy in stages as the price falls. It takes the emotion out of it and seriously helps you manage your risk, something that would have been very, very useful during that Ripper crash.
And ultimately, the wild story of River leaves every investor with the most important question of all. When its price crashed 86%, was that a healthy dip, a golden opportunity to buy groundbreaking tech on sale? Or was it a falling knife, something that was destined to collapse under the weight of a giant whale and a bloated valuation? For any investor telling the difference, well, that's the entire game.